Okay. Hi, everyone. This is the first video of Monetary and Financial Economics B2. My name is Halna Yamada. I'm a lecturer of this course. Today, I'm going to lecture the first lecture of this Monetary and Financial Economics B2. But if you need introduction for this course, entire course, please see the lecture course, the course outline slide. Sorry, please check the course outline slide. Okay. So now I'm going to share the slide. Okay. Wait a minute. Oh, something doesn't work. Sorry. Wait a minute. Oh. Okay, now you can see the slide. Okay. So the first topic is the central bank intervention and the fixed exchange rate. Okay. In today's lecture, we will cover why study fixed exchange rates and central bank intervention and the monetary supply, and also how the central bank fixes the exchange rate. So today's topic is the fixed exchange rate. So now we move on to the first topic, why study fixed exchange rate. So you know that most of the advanced economies are floating exchange rate systems, 変動相場制 in Japanese. So fixed exchange rate is the old exchange rate system. So then why do we study such an old system, fixed exchange rate? So there are several motivations. The first motivation is managed floating. So central banks may intervene in currency markets to influence exchange rates even under floating exchange rate systems. So the present monetary system is not a perfect, completely floating. So the present monetary system is a hybrid of pure fixed exchange rate and floating exchange rate systems. So today's monetary system is a mixture of fixed exchange rate and floating exchange rate systems. We need to study the effect of fixed exchange rates. Okay, second motivation is the regional currency arrangements. So some countries belong to exchange rate unions such as EU, European Union. So exchange rate unions are organizations whose members agree to fix their mutual exchange rates while allowing their currencies to fluctuate against the currencies of non-member countries. So the example of exchange rate unions, EU, the European Union. Okay, so since there's some countries belonging to the exchange rate unions, we need to study fixed exchange rates. Okay, third motivation is the developing countries. So many developing countries try to peg or manage the values of their currencies to the dollar or some other currencies. So in fact, floating exchange rate countries account for less than a sixth, so this is sixth of the world's currencies. So because floating exchange rate countries are limited, and most of developing countries are pegging their currency to dollar or other currencies, we need to study the fixed exchange rate to analyze the developing countries. Okay, this is a very intuitive plot. Okay, so this figure shows the green area is floating exchange rate system countries. And the blue area is the soft pegs countries. And the orange country is the hard peg countries. And you can see that so there are several countries belonging to the floating systems. So, but such countries are mostly advanced economies. So advanced economies tend to be floating countries, tend to be floating exchange rate, but many developing or emerging countries are soft pegs. So there are so many countries of fixed exchange rate systems. So to analyze such developed or to analyze such developing or emerging countries, we need to know the fixed exchange rate. Okay, so the last motivation is the lessons of the past for the future. So floating exchange rate cannot be a perfect system. So in the past, many economists believed that floating exchange rate can be a perfect exchange rate system, but in reality, it cannot be a perfect system. Okay, so then what is the new international agreement on exchange rate? So we seek our economists. So we economists seek the new international agreement on exchange rate. But to consider such a new international agreement, we need to know the merits and disadvantages of fixed and floating exchange rates. So to do so, to compare the merits or disadvantages of fixed and floating exchange rates, we must understand the functioning of fixed exchange rates. Okay, now move on to the second topic, that is central bank intervention and the money supply. So by the way, in this lecture, I use CB, the letter CB as central bank. So CB here means central bank, okay? So now I introduce very important concept, that is central bank balance sheet. So the central bank balance sheet records the assets held by the central bank and its liabilities held by the central bank. Okay, so the central bank balance sheet follows the principles of double entry bookkeeping in Japanese, which is called fukushiki boki. Okay, so any acquisition of an asset by the central bank causes a positive change on the asset side of the balance sheet. In contrast, any increase in the central bank's liabilities causes a positive change on the liabilities side. Okay, so this is the example of central bank balance sheet. So this is the example. There are two sides, okay? Asset side and the liabilities side. So asset side records assets transactions and liabilities side records liabilities transactions. So in here, there are two separates in the asset side. The first one is foreign assets, which is $1,000. $1,000. Sorry, by the way, so if you're taking the B1, you already know that, but I cannot pronounce the numbers in English. I hate the pronouncing the numbers in English. So if I confuse the pronunciations, but please ignore that. Okay. Okay. So again, so foreign asset is $1,000. And the second one is domestic asset. So domestic asset is $1,500. Okay, there are two components in the liabilities side. Okay, the first one is deposits held by private banks. So which is $500. And secondly, so the currency in circulation. So this is $2,000. Okay. Foreign assets and the asset side. So this is the foreign currency bonds owned by the central bank. So which is called official international reserves, or in short, official reserves. Okay, or just reserves. So we call it just reserves. We often call it just reserves. Okay. So because this record is based on the double entry bookkeeping, total assets should be equal to the total liabilities plus net worth. So in this example, net worth is 0. So therefore, total assets equal total liabilities, and which is equal to the $2,500. So you can see that 1,000 plus 1,500 gonna be 2,500, and also 500 plus 2,000 equal to the also 2,500. So you can easily check the total assets equal to the total liabilities. Okay. Net worth is often ignored. So when we ignore the net worth, then total assets exactly equal to the total liabilities. So therefore, the changes in the central bank assets automatically cause equal changes in central bank liabilities. So let's consider the example. So purchasing assets increase the asset side. Okay, so this is the asset side transactions. Okay, so the purchasing assets accompanied by, a purchasing asset causes two types of payments. So the two different types of payment. And the first one is cash payment, and the second one is a check payment. The cash payment raises the supply of currency in circulation. And the second option is a check payment. So a payment by check promises a private bank a central bank. So both cash payment or check payment increase the liabilities side. Okay, so payments are recorded in the, basically payments are recorded in the liabilities side. So the cash payment and the check payment also, so both check payment and the cash payment records in the liabilities side. Okay. So now consider an example. The central bank buys an asset from the public. Then such payment of the central bank can be a cash or payment, cash or check. So such payment is called domestic money supply. So such payments are called domestic money supply, okay? So the increase in central bank liabilities associated with the asset purchase causes the monetary supply to expand. So the increase in the central bank liabilities causes the monetary supply to expand, okay? In contrast, selling central bank assets decreases central bank liabilities and causes the monetary supply to shrink. So therefore, selling or buying central bank assets changes the domestic money supply. Okay. When the central bank buys assets, the accompanying increase in the money supply is generally larger than the initial asset purchase. So this is because money multiplier effect. So this is because of the money multiplier effect. So the money multiplier effect, so it's caused by multiple deposit creation within the private banking system. So if the central bank buys assets from the public, from private banks, the private bank lends to the farms or households. Then such farms and households deposit the funds another bank. Then another bank lends to another farms and households. Such a money creation causes the money multiplier effect. Okay? So therefore, when the central bank buys assets, the accompanying increase in the money supply is generally larger than the initial asset purchase. So this is because of the multiple deposit creation within the private banking system. Okay. Now consider the foreign exchange intervention. So in the fixed exchange rate, foreign exchange intervention is necessary to fix the exchange rate. Okay. Suppose the Bank of Peculiar goes to the foreign exchange market and sells $1,000 worth of foreign bonds for pecuniary money. Then now the central bank sells $100 worth of foreign bonds. Then foreign asset here decreases to the $900. So this payment is for pecuniary money. So the currency in circulation decreases $1,100, and it will be $1,900. Okay. Foreign asset and the currency in circulation both decrease $100 because the asset is sold by the central bank, money supply increases. Okay, so now I confused that greater money supply, so no reduction in money supply, I guess. So therefore, because the increase in since the increase in the central bank liabilities causes money supply to expand, this exercise, so in this exercise, liability side decreases. So therefore, this is a mistake. Greater, not shorter, or reduction in money supply. Sorry for that. Okay. So the stylized, so now I introduce another type of intervention, which is called stylized. So this is hard to pronounce, okay? because I have some difficulties in pronouncing R, like most of Japanese. So this sterilized is very difficult. So it's very difficult to pronounce the sterilized. Okay. So anyway, go back to the lecture. Okay, sterilized foreign exchange intervention. Now I introduce sterilized foreign exchange intervention. So this intervention is that carrying out equal foreign and domestic asset transactions in opposite directions to nullify this is also hard to pronounce. Okay, nullify. It's difficult to study the English. Okay. The sterilized foreign exchange intervention is that carrying out equal foreign and domestic asset transaction in opposite transaction to cancel out the impact of their intervention on the domestic money supply. Okay, so the considered situation. Suppose the Bank of Pecunia sells $1,100 of its foreign assets and receives a 100 check from the Pecunia private bank. So this is the exercise in the past, okay, in the previous slide. So this is the exercise in here. So this is just foreign exchange intervention, but so this is the sterilized foreign exchange intervention. We add new intervention that is buying $100 of domestic assets. So therefore, the decline and increase in the liabilities is canceled out. Okay. The central bank sells the foreign asset and then buy the domestic asset. So the before sterilization, just standard foreign exchange intervention, the balance sheet can be written like this. So in the asset side, foreign asset is now $900. And the liability side, deposits held by private banks gonna be 400. So this is the balance sheet before the sterilization. Now the central bank do the sterilization. Then the balance sheet becomes, the foreign asset becomes 900. So this is same as before the sterilization. But central banks buy the domestic assets. So the central bank's domestic assets are gonna be $1,600. So increase from before the sterilization. Okay, on the liabilities side, central bank sell and buy. So therefore, this transaction is canceled out. And therefore, so deposits held by private bank gonna be $500. So which is the level before the intervention. Okay. So now I also introduce another concept. So that is balance of payment. So a country's balance of payment equal to the net purchase of foreign assets by the central bank, by the home central bank, minus net purchase of domestic assets by the foreign central bank. So therefore, balance of payments means that international payments gap that central bank must finance through their reserve transactions. So a home balance of payment deficit means that increase in the country's net liabilities. So a home balance of payment deficit means increase the country's net liabilities. So some combination of reserve selling is converting the deficit. So some combination of reserve selling is necessary for covering the deficit. Covering the deficit. Okay. So if the central banks are not stabilizing and the home and foreign country has a BOP, balance of payment surplus, then any associated increase in the home central bank's holding assets implies an increased home money supply. Conversely, any associated decrease in the holding central bank's foreign claims on the home currency implies a decreased holding money supply. So this is a relationship between balance of payments and money supply. So now I move on to the next topic in the next video. So you can see the next video by the Google Classroom. So please check.